You shouldn't try and time the market. When the market soars, it's not necessarily time to sell. When the market collapses, it's not always time to buy. Take a small portion of your income every month and invest it. That's averaging in. That's the idea. Maybe it's 10%, maybe it's 5% of your salary. Put that aside regardless of what the market's doing. Because over time, if you buy companies that are profitable and pay dividends, you'll grow as an investor. Your assets will grow. That's basically your nest egg you're talking about there. And if you average in, you'll get the highs, you'll get the lows, but over time, your nest egg will grow, and that's what matters. When you're 65, if you only put 10% of your salary aside when you started at 21, you'd have about $1.2 million in the bank if you just had the average salary in America of $56,000. Think about that. You don't have to die penniless. All you have to do is put a little aside every week. What everybody should understand about the stock market is it has its own forces at play. Nobody can control it. Every day the world makes decisions on what they want to pay for any stock and what price-earnings ratio, in other words, what multiple of this year's earnings are they willing to pay. Very often, this is an emotional decision. Sometimes there's exuberance in the market and investors are willing to pay more. Sometimes when they get concerned and they're risk-adverse, they want to pay less. That's called volatility. Price swings of up to 30 and 40% are not uncommon in the stock market when you look over 100 years of history. So when you see a violent day where the stocks go down 5 or 6%, get over it. It's normal. In fact, not having volatility is not normal. And we've been in a period of 3 years where there hasn't been a lot of volatility. Now we're back to normal. So get used to these swings. And the key to it is invest over time. Sometimes you'll buy stocks when they're very cheap. Sometimes you'll pay more for them. But if you average in over time, that's a very good long-term strategy. And when it comes to volatility, don't let it affect you. Don't get emotional about stocks. They never cry for you, so you shouldn't cry for them.